Financial management can be defined as the management of the finances of a business/organization in order to achieve financial objectives. Taking a commercial business as the most common organizational structure, the key objectives of financial management would be to create wealth for the business, generate cash, and provide an adequate return on investment, bearing in mind the risks that the business is taking and the resources invested. There are three key elements to the process of financial management: financial planning, financial control, financial decision making. Financial planning. Management need to ensure that enough funding is available at the right time to meet the needs of the business. In the short term, funding may be needed to invest in equipment and stocks, pay employees, and fund sales made on credit. In the medium and long term, funding may be required for significant additions to the productive capacity of the business or to make acquisitions. Financial control. Financial control is a critically important activity to help the business ensure that the business is meeting its objectives. Financial control addresses questions such as: are assets being used efficiently? Are the business's assets secure? Do management act in the best interest of shareholders and in accordance with business rules? Financial decision making. The key aspects of financial decision making relate to investment, financing, and dividends. Investments must be financed in some way, however, there are always financing alternatives that can be considered. For example, it is possible to raise finance from selling new shares, borrowing from banks, or taking credit from suppliers. A key financing decision is whether profits earned by the business should be retained rather than distributed to shareholders via dividends. If dividends are too high, the business may be starved of funding to reinvest in growing revenues and profits further. Functions of financial management. The financial management functions encompass the entire spectrum of the firm's activities. Financial management is important not only for individuals in finance but also for those in other areas, since these decisions, directly or indirectly, influence the fortunes of the firm. The functions of financial management can be divided into two groups: executives functions. These functions involve financial, investment, and dividend decision making. These decisions require administrative skill, financial competence, and technical foresight. Since the main objective of financial management is to maximize the value of the firm, it makes the following important decisions: evaluating, securing, and servicing long-term financing from within the firm or from capital market instruments such as common or preferred stock, debt, lease, warrant, or convertibles. Management of the marginal cost of capital through attention to the firm's target capital structure and the various sources of funds available to the firm. Distribution of funds to the firm's shareholders through a cash dividend policy. Securing, managing, and investing in current assets such as cash, accounts receivable, and inventory. Obtaining short-term financing from creditors or from the money markets. Planning for the ongoing activities of the firm and ensuring that the firm responds to the changing financial and economic environment. Routine functions. These functions are expected to be performed at a low level and include record keeping and reporting, preparation of various financial statements, cash planning and its supervision, credit management, custody of and safeguarding different financial securities, providing top management with information on current and prospective financial conditions of the business as a basis for policy decisions on purchases, marketing, and pricing. Objectives of financial management. The financial management is generally concerned with procurement, allocation, and control of financial resources of a concern. The objectives are: to ensure regular and adequate supply of funds to the concern, to ensure adequate returns to the shareholders, which will depend upon the earning capacity, market price of the share, expectations of the shareholders, to ensure optimum funds utilization. Once the funds are procured, they should be utilized in maximum possible way at least cost. To ensure safety on investment, i.e., funds should be invested in safe ventures so that adequate rate of return can be achieved. To plan a sound capital structure, there should be sound and fair composition of capital so that a balance is maintained between debt and equity capital. Goals and scope of financial management. Goals of financial management. Profit maximization. Maximization of profits is very often considered as the main objective of a business enterprise. The objective of financial management is the same as the objective of a company, which is to earn profit. The shareholders, the owners of the business, invest their funds in the business with the hope of getting higher dividend on their investment. Moreover, The profitability of the business is an indicator of the sound health of the organization because it safeguards the economic interests of various social groups which are directly or indirectly connected with the company, e.g., shareholders, creditors, and employees. Wealth maximization. The wealth maximization, also known as value maximization or net present worth maximization, is also a universally accepted criterion for financial decision making. The value of an asset should be viewed in terms of benefits it can produce over the cost of capital investment. The value of a firm is represented by the market price of the company's stock. The market price of a firm's stock represents the assessment of all market participants as to what the value of the particular firm is. Scope of financial management. Procurement of short-term and long-term funds from financial institutions. Mobilization of funds through financial instruments such as equity shares, preference shares, debentures shares, bonds, notes, and so forth. Standard forms of financial statement. Each business entity is required to prepare a set of financial statement at a definite periodic interval. Financial statements include balance sheet and profit and loss account. These statements are essentially meant for internal and external reporting. Internal reporting of financial statements. Internal reporting of financial statements to the management helps the following areas: decision on the policy matters, exercise control, appraise the performance of various levels of organization, motivate to achieve better performance, ensure better coordination, planning for the future. External reporting of financial statements. External reporting of balance sheet and profit and loss account includes shareholders, financial institutions / banks, taxation authorities, government and semi-government expenditure statement. Income and expenditure statement, popularly known as profit and loss account, shows the summary of income and expenses during a specified period. It includes the following segments: sale of products / services, income from other than sales, manufacturing / factory cost, office and administrative cost, selling and distribution cost, finance cost, and non-operating cost. Balance sheet. The balance sheet is a statement which reveals its assets and liabilities on a particular date. It is not an account. As a convention, the liabilities are recorded on the left side while the assets on the right side. Total of both sides of the balance sheet must tally with each other. The liabilities are total funds of the business, which include the owner's funds and borrowed funds. These funds are invested in various assets of an enterprise to earn profit. Therefore, total of the assets must tally with the total of funds invested in them. Fixed and current asset items. Assets are the valuable resources owned by the business entity and are used as the main criteria to earn profit. Since the assets are acquired at cost, they have money value. For inclusion in the balance sheet, assets are divided into four main categories. Current assets. It consists of cash, bank balances, short-term investments, bills receivables, inventories or stock of all kinds, prepaid expenses, accrued income, advances recoverable in cash or in kind for value to be received, short-term loans made, deposits kept with various authorities, advance payment on income tax, current accounts, etc. Fixed assets. It consists of land, building, plant and machinery, furniture and fittings, electric installations, equipment, vehicles, etc. Miscellaneous assets. It consists of deferred revenue, expenditure, underwriting commission, preliminary expenses, development expenditure, R&D costs and accumulated losses. Intangible assets. It consists of goodwill, technical know-how, patent, trademarks, copyrights, etc. Contrary to the assets, liabilities are claims on the business and against all assets by the owners and outside creditors. At the same time, they are the sources of funds. For inclusion in the balance sheet, liabilities are classified into four main categories. Current liabilities. It consists of trade creditors, accounts payable, bills payable, short-term loans from banks and others, short-term fixed deposit, short-term portion of long-term loans, outstanding advances from customers, provisions for taxation, proposed dividend, unpaid dividend, etc. Long-term liabilities. It consists of debentures, long-term loans from banks and financial institutions, deferred payment credits, long-term fixed deposits, loans from other convertible bonds, etc. Reserves. It consists of capital reserves, committed reserves, general reserves, dividend equalization reserves, other free reserves, development rebate reserve, investment allowances reserve, share premium, etc. Share capital. It consists of paid-up portion of share capital preference and equity share. Mechanics of account. The maintenance of books of accounts has been made compulsory under various laws. In order to ensure the compliance with the statutory provisions, following books of accounts become necessary. Cash books. All transactions in cash and / or check are entered in cash book, viz. Receipt and payments. Transactions are recorded in appropriate columns with necessary details. This book is balanced regularly so that the balance of cash or bank account can be ascertained. Sales books. All transactions of sales are recorded in sales books. Entries in sales book are made on the basis of invoice/bills which are prepared, addressed to customers after the goods are dispatched. More than one sales book is required to be prepared for different groups of products, territories, brackets, etc. Purchase book. All transactions of purchase are recorded in purchase book. Entries in purchase book are made on the basis of bills/invoices which are received from suppliers whenever goods are purchased. Be made, viz. Cancellations, reductions for equality rebate/discount, reduction for short quantity dispatched, reduction for damaged goods, etc. To incorporate such adjustments in the accounts, either debit note or credit note is issued against or in favor of supplier/customer. These debit and credit notes are recorded in the debit/credit note registers. Journal. All transactions which cannot be recorded in any book are entered in journal. These include inter alia, rectification entries, transfer entries, closing entries, adjustments, provisions, etc. Ledger. Once the transaction is recorded in the appropriate book/register, it has to be posted in the ledger to the appropriate account. Since each and every transaction is recorded with respect to dual aspect, it is posted to debit and credit of the appropriate account. Each account in ledger represents a summarized record of all transactions concerning that particular account.